$187,000. That's not a retirement goal. That's the threshold, the exact portfolio range where the math of compound interest structurally changes. Below it, you're the engine. Above it, compound interest is. And right now, most people between 40 and 55 are working twice as hard as they need to because no one drew them that line. The issue is not that you are not saving enough. The issue is that compound interest has an activation point, a specific portfolio size where the math fundamentally changes behavior. And for adults between 35 and 55 with working retirement accounts, misunderstanding that activation point costs somewhere between $200,000 and $500,000 in lifetime wealth. Not because you did anything wrong, because nobody explained the geometry of the curve you are on. Most people think compound interest is a savings accelerator. You put money in, it grows a little faster than a savings account, and over enough decades, you end up with a comfortable nest egg. That is the version you were taught. The mechanism underneath, the part that actually determines whether compound interest transforms your financial life or just mildly improves it, is the relationship between your portfolio size and your annual contribution capacity. Think of it like plumbing. You can have the best water pressure in the world, but if the pipes are too narrow, the flow stays the same. Compound interest is the pressure. Your portfolio balance is the diameter of the pipe. Below a certain diameter, the pressure barely matters. Above it, water flows faster than you could ever carry it in buckets. And here is where I need to challenge something you have probably internalized without realizing it. The entire financial planning industry is organized around a destination number. What do you need to retire? 1.2 million, 1.46 million, 2 million. Pick your survey, pick your year. The number is always large and always far away. But that destination number is not the number that matters most in your financial life. The number that matters most is far lower than that. It is the number where compound interest stops being a passenger in your portfolio and starts driving. That number, my friend, is lower than you think. And the fact that it is lower than you think is precisely why most people miss it entirely. Are you the boulder pusher or the positioned investor right now? One word. Drop it below. Push-in or positioned. I read every comment. Let me walk you through what I mean by the activation point, because this is not a feeling. It is arithmetic. Compound interest is not a constant force. It is not a gentle wind at your back that blows the same speed whether you have $10,000 or $500,000. It is a force that scales with your base. And because it scales with your base, there is a specific portfolio size where the annual return generated by your investments exceeds what you are personally contributing each year. That is the activation point. Below it, you are the engine. Your labor, your discipline, your monthly transfers are doing the majority of the work. Above it, the market is the engine. You are still contributing, but your contribution is now the smaller number in the equation. That distinction costs people years. And the financial planning system has no incentive to explain it, because once you understand it, you stop needing as much help. You stop paying for complex strategies designed to optimize a phase of growth you no longer in. Most people focus on their rate of return. They agonize over fund selection. They compare this index to that index. They read articles about whether to tilt toward value or growth, international or domestic. The actual leverage is not your return rate. It is how quickly you can get your portfolio across the activation threshold, not an addition to your strategy, a multiplier of everything your strategy does afterward. Think about that. I call this the activation threshold rule. Below the threshold, every dollar of growth in your portfolio is primarily a product of your effort, your paycheck, your discipline, your sacrifice. Above it, every dollar of growth is primarily a product of the market working on your existing base. The math does not negotiate. It does not care about your income level, your job title, or how sophisticated your investment approach is. It only cares about the size of the base it gets to work on. So what is the actual number? Let me be direct about that. Most people are sitting somewhere between $80,000 and $200,000 in their retirement accounts during their late 30s and 40s. The Federal Reserve data tells us the median American between 55 and 64 has roughly $185,000 saved. Many people in the 40 to 55 range are well below that. And here is the pattern that the data reveals consistently. At around $100,000, something quietly shifts. The S&P 500 has delivered approximately 10% annually over the last 3 decades. At that rate, a $100,000 portfolio generates roughly $10,000 per year in returns. The average 401k contribution in 2025, according to Fidelity data covering about 24.5 million participants, was $9,080. So right at $100,000, your portfolio begins producing more annual growth than the average American is actively putting in. You crossed a line and nobody told you. But here is the thing. That first activation at $100,000 is not where the real power lives. It is where the possibility begins. The real shift, the one that changes the trajectory of your entire financial future, happens approximately $250,000. In 2026, the maximum legal 401k contribution is $24,500. At 10% returns, $250,000 generates $25,000 annually. That means once you cross $250,000, your portfolio earns more per year than you are legally allowed to contribute. The government put a ceiling on your effort. The market has no ceiling. Your contributions become the minority partner. The compounding becomes the majority shareholder. That is the sweet spot, and it is far lower than the $1.46 million that Americans say they need to retire comfortably. The sweet spot is not your destination. It is the turning point on the road to your destination, and most people drive right past it without realizing the road just changed underneath them. This happened clearly in the data from Fidelity's fourth quarter 2025 report. Investors who had been contributing continuously for 15 years had average balances of approximately $617,600. Those who had been contributing for 10 years had roughly $465,000. That gap, about $152,000, did not accumulate because people saved dramatically more in years 11 through 15. It accumulated because somewhere around year 10 or 11, those portfolios crossed the activation threshold. The compounding engine took over. The growth accelerated not because the contributions changed, but because the base reached the right size. The mechanism is identical regardless of when you start. I am not predicting future returns. I am showing you the pattern that has repeated across every major time window in modern market history. Let me put this in a different frame so it really lands. Imagine 2 people. Person A has $120,000 invested and contributes $500 per month. Person B has $260,000 invested and contributes $500 per month. Same contribution, same fund, same return rate. After 15 years at 10% average returns, Person A ends up with approximately $580,000. Person B ends up with approximately $1,180,000. The gap is $600,000. Not because of income, not because of stock picking, because of the activation threshold rule. Person B started above the sweet spot. Every year the market was doing more work on Person B's portfolio than on Person A's. That advantage compounded annually. By year 15, it was no longer a gap. It was a canyon. Stop for a moment. We have covered the activation threshold and the activation threshold rule. If you are building a system around this, subscribe. Because what comes next are the 3 steps that make this practical. But first, I need to address something that actively works against you reaching the sweet spot. And it is the thing most people consider a minor detail: fees. A 1% annual advisory fee on a portfolio does not cost you 1%. That is the trap. It costs you the compounding on that 1% for every remaining year of your investing life. On a $1 million portfolio earning 7% over 30 years, the difference between a 0.25% total cost and a 1% total cost is approximately $1.3 million. That is not an opinion. That is the arithmetic of compound drag. But here is where it matters most for this conversation. The damage from fees is most severe between the first and second threshold. When your portfolio is between $100,000 and $250,000, you are in the most sensitive zone of the compounding curve. Your growth is real, but still modest in absolute terms. A 1% fee at this stage is not just money leaving your account. It is time being added to your journey. It pushes the activation point further away. It keeps you in the phase where you are the primary engine for longer. And every extra year you spend below the sweet spot is a year where the market is not yet doing the heavy lifting. Let me be direct about that. Switching from a managed fund with a 1.2% expense ratio to a broad market index fund at 0.03% on a $150,000 portfolio over 20 years saves you roughly $90,000 in compounding drag. That is not a rounding error. That is the difference between crossing the activation point at 47 versus crossing it at 44. 3 years. 3 years of the market working as your primary wealth engine instead of you pushing the boulder yourself. Before we continue, this is exactly why we built the Trip to Wealth Command Center. Understanding compound interest is one thing. Applying it to your own financial life is where everything changes. The system brings together the Command Center Google Sheet and 2 companion guides, The Compounding Mind and Starting Late, Investing Smart. The Command Center helps you organize your numbers, track your cash flow, net worth, goals, and compounding projections. The guides help you understand the mindset, habits, and step-by-step path behind long-term wealth building, especially if you feel like you're starting later than you hoped. Together, they were designed to make compounding feel less abstract and more practical. It is now available through the link in the description. Back to the framework, here is a concept I want you to sit with, because it explains why so many people in their early 40s feel stuck even though they have been doing the right things. I call it the flat zone. The flat zone is the period between roughly $80,000 and $220,000 where your portfolio is growing, but the growth does not feel proportional to the effort. You are saving aggressively. You are making sacrifices. You are watching your friends buy new cars and take trips. And your account goes from $142,000 to $161,000 in a year, and it just does not feel like it is working. That is because you are on the flattest part of an exponential curve. Exponential growth has a specific shape. It is nearly horizontal for a long time. Then it bends. Then it goes almost vertical. The flat zone is the horizontal part. And the tragedy is that most people either give up or pull back their contributions during the flat zone because the feedback loop does not match the effort. They reduce their 401k percentage. They tap the portfolio for an emergency. They switch strategies looking for faster returns. Every one of those decisions extends the flat zone and delays the bend. Think about someone who has $180,000 saved at age 43. They have been contributing steadily for over a decade. At 10%, that portfolio generates about $18,000 per year in returns. Their maximum legal contribution is $24,500. The market is doing significant work, but it is still less than what they are personally allowed to put in. They are close. Painfully close. But they are still in the flat zone. Now watch what happens if that person makes a focused 3-year push. They eliminate one major recurring expense. They redirect lifestyle inflation. They add $6,000 to $8,000 per year above their current contributions. In 3 years, with 10% compounding, that $180,000 becomes roughly $265,000 to $275,000. They have crossed the sweet spot. The market is now their primary wealth builder. For the first time, they could theoretically stop contributing entirely, and the portfolio would still grow faster annually than their maximum allowable contribution. That 3-year push was not about willpower. It was about understanding exactly where the bend in the curve was and sprinting toward it. There is also a third level that most financial advisors never discuss with clients. At approximately $580,000, a portfolio earning 10% annually generates about $58,000 per year. The Bureau of Labor Statistics reports the average full-time salary for workers 25 to 34 was around $57,564 in late 2024. At $580,000, your portfolio produces more annual income than the average American earns working full-time. Your money has replaced a salary, not as a metaphor, in actual dollar output. That is the third threshold. And the reason most advisors do not highlight it is because once you understand it, the urgency shifts from accumulating endlessly to protecting what you have built. The product you need from them changes. Some of them would rather you keep chasing a number north of $1 million. Let me give you the 3 steps that compress the timeline. Step 1. Locate your zone. Open your most recent investment statement. Take your total invested balance and multiply it by 0.10. That gives you your approximate annual return at historical averages. Now compare that number to your annual contribution. If your return is less than your contribution, you are below the sweet spot. Your primary job is not fund optimization, it is base acceleration. If your return exceeds your contribution, you have crossed the activation point. Your primary job shifts to protecting the compounding engine from drag. This single diagnostic tells you what phase of the game you are in, and the strategies for each phase are completely different. Step 2. Eliminate drag. Between the first threshold at $100,000 and the second at $250,000, your portfolio is in its most fragile growth phase. Every dollar of unnecessary cost delays the bend in the curve. Audit 3 things: your fund expense ratios. If anything is above 0.20%, research lower-cost alternatives in the same asset class. Your advisory fees. If you are paying percentage-based advisory fees on a portfolio that is primarily in index funds, calculate what that costs you in compounding over 20 years. You may find that the advice is costing more than the advice is worth. Your debt structure. Any debt with an interest rate below your expected investment return is mathematical fuel for debate. But any debt with an interest rate above your expected return is actively competing with your portfolio for the same dollars. Eliminate the high-interest debt first. It is not about morality. It is about which dollar deployed where gets you across the threshold fastest. Step 3. Compress the timeline. This is where the real leverage lives. If you are within $50,000 to $70,000 of the $250,000 sweet spot, a focused 2 to 3 year push can fundamentally alter your financial trajectory for the next 20 years. Identify 1 to 2 discretionary expenses that total $3,000 to $6,000 annually. Redirect them into your investment account. If you have access to catch-up contributions and you are over 50, use them. The 2026 catch-up limit adds additional contribution room that most people leave untouched. Consider whether a Roth conversion ladder or backdoor Roth strategy is appropriate for your tax situation, because the interaction between taxes and compounding is another form of drag that most people ignore during the flat zone. This week, the actions are straightforward. Action 1. Calculate your portfolio return versus your contribution and determine which zone you are in. Action 2. List every fee attached to your investment accounts and calculate the 20-year compounding cost of each one. Action 3. Identify one recurring expense above $200 per month that does not directly improve your health, income, or relationships, and redirect it toward your investment base for the next 12 months. 3 actions. 1 decision. The decision is whether you want to keep pushing the boulder or whether you want to get to the point where the hill pushes it for you. My friend, here is what I want you to take away from everything we covered. The compound interest sweet spot is not $1 million. It is not even close. It is the point where the market contributes more to your wealth annually than you are able to contribute yourself. For most people using tax-advantaged accounts, that number sits right around $250,000. And the distance between where you are now and that number is the most consequential gap in your entire financial life. Not the gap between $250,000 and $1 million. Not the gap between $1 million and $2 million. The gap between where you are and the sweet spot. Because once you cross it, the math changes permanently. Every year after the crossing, the market does more. You do less. The curve bends. The growth accelerates. And the next million comes faster than the first $250,000 ever did. Not a savings plan, a positioning strategy. That is the difference. The compound interest sweet spot is not about how much you save. It is about understanding exactly when the math shifts in your favor and doing everything in your power to reach that point as fast as possible. Everything after the sweet spot is momentum. Everything before it is effort. Know which side you are on. Act accordingly. Legal disclaimer. I am not a financial advisor. The content on this channel is for educational and informational purposes only. Investing involves risk. Always conduct your own research or consult with a professional before making financial decisions. If this breakdown brought you clarity, I highly recommend watching my next video. Don't forget to like, share, and subscribe to our channel. Also, feel free to leave your comment below, especially if this video made you think differently. Thanks for watching. I'll see you in the next one.